The badge says intern. It has always said that. In this building, on this floor, at this particular desk wedged between a Bloomberg terminal and a recycling bin nobody empties, that word means something specific. It means you are not yet a cost center. You are a test. A signal being read by people who will never introduce themselves. You are 21 years old. You are from somewhere that felt large until you arrived here. The fund manages 4.7 billion. You will never touch any of it. Your job is to build a comparable company analysis for a position the PM has already decided on. You don't know that yet. You will. You work until the cleaning crew arrives, then pass them. You learn the difference between a 10K and a 10Q. In the same week, you learn which elevator the senior partners use and why you should not be in it. These are equally important lessons. Nobody tells you that. You figure it out. The first rule. Every room has a hierarchy invisible to anyone who hasn't earned the ability to see it. Your job before anything else is to learn to see it. You get the offer. Full-time. Analyst. The number feels enormous until you divide it by the hours. You don't divide it by the hours. You accept before they finish the sentence. Your desk is different now, marginally. The recycling bin is someone else's problem. You cover two sectors, consumer discretionary and industrial machinery. You build models that your associate reviews and returns with comments in red. Always red. The comments are not cruel. They are precise. Precision at this level is a form of respect you will only recognize in retrospect. The fund runs a long short book. You are learning what that means, not from a textbook, but from watching a $340 million position move against the thesis on a Tuesday and watching the PM not flinch. That is your first real education, not the model, not the comp, the not flinching. You write your first investment memo, 14 pages, single-spaced. You cite 17 sources. Your associate reads it in 4 minutes and tells you the thesis is buried on page 9. It should be in the first sentence. You rewrite it. 3 sentences. The thesis is now in the first sentence. Your associate reads it in 40 seconds and says nothing. That is approval. You begin to understand that clarity is a form of aggression in this industry. Vagueness is a liability. Precision is currency. You spend the next 18 months becoming more precise. The second rule, the memo is never about the company. It is about the variant perception. What does the market believe? What do you believe? Why is the gap real and not imaginary? Everything else is noise. You are 27. Your title is senior analyst. You cover 4 sectors now. You have a position that is entirely yours, a mid-cap logistics company that nobody on the street is covering properly. You spent 3 months building the thesis, channel checks, supplier conversations, a distributor in Memphis who told you something on background that confirmed everything. The PM puts on $180 million, so the stock moves 34% over the next 6 months. Your name is not in any press release. The fund does not issue press releases. But in the morning meeting, the PM says your name. Once. In context. In front of the room. That is the only acknowledgement that will ever happen. You understand this is the culture. You respect it. You have become part of it without noticing when the transition occurred. You begin taking calls from recruiters, other funds, a multi-manager platform offering you your own sleeve. You decline. You are not finished learning here. That is a sentence you will only be able to say for a limited time. You know that. You say it anyway. You work on a short position that goes wrong, a biotech. The data was clean, the thesis was clean. The FDA approved a drug you had assessed a 30% chance of approval. The stock moves 80% against you in a single session. The PM covers at the open, no autopsy in the meeting, no blame assigned. The PM says, we were wrong on the probability weight. Note it, move on. You note it. You do not fully move on. That position lives in the back of your mind for 2 years. Later you will understand that is where the real learning lives, not in the wins, in the positions that moved against you while your reasoning was sound. The third rule, being wrong with good process is not the same as being wrong. The fund that cannot tell the difference between the two will not survive a full market cycle. Portfolio manager, your own book, $600 million in gross exposure, long and short, you set the sizing, you manage the risk parameters yourself, your deputy runs the models now. You run the logic. The difference between an analyst and a PM is not intelligence. It is accountability structure. An analyst can be right and have nothing happen. A PM cannot afford that luxury. Every position is a decision with consequences attached. The weight of that is different from anything the title prepared you for. You develop a style. Concentrated, high conviction. You run 12 to 15 positions at a time. No more. You know each one completely. You can discuss any of them from memory at any hour without preparation. That is the standard you set for yourself before you set it for anyone else. You have 2 analysts reporting to you. You review their memos the way your associate reviewed yours. In red. Precisely. As a form of respect they will only recognize later. The fund has a difficult year. Macro events disrupt the book in ways no single stock analysis could have anticipated. You finish down 11%. The benchmark is down 19%. On a relative basis, you outperformed. On an absolute basis, you lost money for your LPs. You feel both things simultaneously and resolve nothing. The 4th rule. Risk management is not what you do when things go wrong. It is the structure you build before anything happens at all. You run the fund now. 3.8 billion, a team of 11, 3 PMs under you running sector-specific books. You set the overall positioning, you manage LP relationships, you present at the annual meeting, you fly to Zurich, you fly to Singapore, you fly to Abu Dhabi. Your LPs are sovereign wealth funds, endowments, a Canadian pension with $900 million allocated to your strategy. You are no longer generating ideas in the traditional sense. You are maintaining the architecture of a system that generates ideas without you. Your edge is no longer analytical, it is structural. You have built a research process, a risk framework, a culture of intellectual honesty that most funds describe but do not practice. At your fund, a PM who is wrong and says so early is rewarded. A PM who is wrong and says so late is managed out. That policy is older than your tenure. You have enforced it 3 times. You have also been on the wrong side of a thesis you held too long. You managed yourself. That story circulates quietly. It is part of why the culture holds. The 5th rule. The fund is not the positions. The fund is the process that selects the positions. Protect the process above everything. Your name is not attached to a fund anymore. It is attached to a framework. A way of thinking about markets that 2 generations of analysts have carried into their own funds, their own books, their own morning meetings in cities you have never visited. You sit on an advisory board for a university endowment. You consult on allocation strategy for a family office managing $6 billion. Occasionally you write, not publicly, a letter to a small circulation, analysts and PMs who have worked with you. Thinking about risk, about variant perception, about what the market is and what it is not. You are 61 years old. You left the fund 4 years ago. The fund continues without you. That is the measure of it, not the returns, not the AUM. The continuation. Someone calls you from a number you don't recognize. A 24-year-old analyst at a fund you respect. He has a question about position sizing in a concentrated book. He found your name through someone who found your name through someone else. You take the call. You answer the question precisely. You do not tell him your name means anything. You tell him the answer. He thanks you. You say nothing. You hang up. Somewhere in a glass tower in a city that moves without stopping, the cleaning crew arrives on the 31st floor. A light is still on, a terminal is still running, a 21-year-old is still at the desk, the badge says Intern, it has always said that. The machine takes another step forward,